and good morning, everyone. Thank you for attending. I'm Jean-Hugues de Lamaze, the portfolio manager for EGL. A quick word on Ecofin for those of you who don't know us. Ecofin has been around for over 30 years as a specialist of utilities, infrastructure, and the energy transition. The name Ecofin used to stand for ecology and finance, and we've managed to actually stick to our focus as specialist investors over the years. In the next few minutes, I'll give you an overview of the trust, of its specific approach to the world of utilities and infrastructure, and where we see a specific opportunity and investment case right now to add to some positions in the space. Ecofin's investment team, a 7-member team. So Matthew Pidou sits next to me, as Neil said. We are, all of us, specialists, passionate about the space, each of us having a specific perspective and angle, and it's the cross-fertilization of our respective perspectives around the global infrastructure universe that we believe adds some value. So infrastructure is quite a well-known universe, but it's mostly well-known for its private typical assets, while EGL focuses on the listed infrastructure universe. We only invest in listed equities. The beauty of infrastructure is well known. Defensive long-term contracts providing high degrees of predictability of the future cash flows and progressing dividends. Typically a defensive asset class. But there are, I would say, two structural supporting thematics at the moment for infrastructure. The first one is quite broad and probably very well known to most of you. The industrialized world lives in infrastructure largely built in the 1950s and 60s, which is aging, needs replacement, and that is a source of CapEx requirements, which are significant and very much unfunded as of today. So part of the growth in infrastructure comes from that. But there is an additional angle, which is very much the one that Ecofin is the most interested in, which is related to the effects of the energy transition on the world of utilities and infrastructure. And I mean by that, decarbonization, electrification, are actually transforming the business models. And we believe this is the source of growth and enhancement of returns. This is very much what I will explain in the next few minutes. So EGL is a product that is trust, which aims at delivering long-term growth while preserving capital. This is very much what the trust has delivered over the years so far, with since 2016 a total return of the share price of 11.2% per annum and NAV total return growth of 9.6% per annum, out of an objective of 6 to 12% per annum. So we very much delivered so far on what was written on the tin. I'll also explain how the discount to NAV currently enhances, we believe, the opportunity that I will describe in a few minutes. Performance track record, to start with, the last fiscal year ended at the end of September 2024, and delivered quite a strong performance of 25.9% for the NAV, 24.8% for the share price. Since admission as at the end of September, 10.2%, 11.8% respectively for NAV and share price. What I believe is worth highlighting is two things. First of all, since admission as at the end of March 2025, the trust has delivered significant added performance compared to the relative underlying sector indices, infrastructure utilities, delivered much higher performance than the FTSE All Share Index, and overall actually has pretty much matched the MSCI World's performance. So that really, I think, illustrates the beauty of the space. Whatever the economic context, we believe this is a strategy which can deliver very close to double-digit total return per annum for investors. So far this year, over the first 3 months of the year, NAV plus 5.9%, share price plus 10.9% as at the end of March. Those numbers speak for themselves. A very defensive strategy in the current turmoil stock markets. The strategy in a nutshell, it's a global strategy with a balance between North America and Pan-Europe, which we really want to maintain because it's a way to diversify risk and to gain exposure to all the big underlying investment thematics that we see in the space. We have decided to cap exposure to emerging markets at 10%, again, mostly for risk purposes. And then income and growth, we want this combination for the portfolio as a whole, but also for each individual name in the portfolio. Income, typically the portfolio yields around 4%. It's currently a bit higher than that. And we also want those dividends to grow. We estimate that the dividends in our portfolio are able to grow by 5 to 7% per annum, which is somewhat higher than the typical utilities or infrastructure business model. And why is that? It's because very much Ecofin's portfolio for EGL is focusing on those companies which are able to deliver faster growth and growth related to structural trends. So we're much more interested in the structural growth trends than in the cyclical part of the investment universe. How do we define utilities and infrastructure worldwide? 3 subsegments: electric and gas utilities, that's the most traditional one, with a growing proportion of renewable energy, which is only one of the components. Environmental services, this is water and waste. And finally, transportation infrastructure. Those are toll roads, airport service management companies. So as you see, those businesses are service businesses, they're asset-backed services. We don't invest in capital goods, so we don't invest in the equipment providers of those companies that operate in the space. It's purely the asset-backed services, long-term types of contracts that we focus on in the strategy. That is for the snapshot. Again, objective 6 to 12% per annum, which we have delivered over the years, as I mentioned. Investment universe, about 400 companies. We have between 40 and 45 in the portfolio, and plenty of space with over $4 trillion of market caps in the investment universe. Main characteristics of the companies in the universe, I briefly alluded to this. Essential assets, long-term contracts with high barriers to entry. Long-term contracts provide high degrees of predictability of future cash flows. And thanks to those predictable cash flows, we have a portfolio which provides exposure to solid and growing dividends. So this is very much part of the objective of the trust. Now, moving on to the specificity of Ecofin's perspective to the world of utilities and infrastructure. I mentioned the underlying thematics, but clearly where Ecofin adds the bulk of the value is in analyzing the effects of the energy transition. And I would mention 3 points, which I will describe in the next few slides. The first one, which is largely overlooked by general markets, we believe, general equity investors, is the significant de-risking of utilities and infrastructure business models over the years, which is actually still going on as we speak. The bar chart at the top of the slide shows you that about 15 years ago, 2008, we show here, close to 50% of the operating profits of the large utilities, listed utilities, were stemming from conventional power generation. This was a business largely commodity driven. very volatile. Good years when commodity prices were going up, and much more unfavorable conditions for those operators when commodity prices were going down. The proportion of commodity-driven conventional power generation has shrunk from 42% in 2008 to about 10% today. And this has been replaced by the growth in either purely regulated businesses or fully contracted businesses, which means that today, about 80%, as you see in the bar chart, about 80% of the cash flows are pretty much predictable because they're based on either a prefixed regulatory model with allowed returns or contracts which fix the price which you're going to get as an operator over the time of your concession. So a much more predictable, much less volatile type of business model than typically you had for utilities in Europe and the US about 15 years ago. That de-risking, we believe, should be a reason for re-rating. And as we will see in a few minutes, we're far from there. And actually, the space is still trading on its historic lows rather than having accounted for this de-risking. As you see in the pie chart at the bottom, we're still at the very early stage of that transition to a de-risk model. About a third of the EBITDA of the largest utilities in Europe stems from renewables, but only about just under 15% in the US. The trend towards decarbonization and electrification will lead to faster growth, enhanced returns, and much de-risked business models. By the way, we have a box at the bottom right of the slide which shows the example of the UK, which is probably the country in the world which has been the fastest at implementing that transition, with the country actually relying for about 50% of its electricity on coal about 15 years ago, and coal last year accounted for 0% of electricity generated in the UK. So in less than 15 years, the country, the UK, has entirely phased out of coal, massive decarbonization, and that's probably one of the most obvious examples of the trends that we are seeing worldwide at the moment. So de-risking of business models, first factor. The second factor, which is quite new to the space, is accelerating growth, notably through increase in demand for electricity. We're coming out of a period of about 20-25 years of flat demand for electricity in OECD markets. Between 1945 and 2000, electricity demand was progressing pretty much in line with GDP. But over the past 25 years, it's been flattish. You have on the bar chart at the top of the slide the statistics for the US, which show pretty much only sort of 9% increase over the past 25 years. So pretty much flat electricity consumption. In Europe, UK, it's actually been declining. And we are entering a phase of dramatic transformation of that. Electricity consumption is bound to increase significantly in the next 20 years on the basis of the structural electrification. When you do refurbishment of your house these days, everything turns electric. The lighting, actually, which was largely decarbonized or most efficiently driven over the past 10 years, is now pretty efficient, but the lighting is increasing, air conditioning is increasing. So electrification plus electric vehicles, which will contribute. And the most recent trend comes from data centers, the development of AI, which is a massive source of demand for electricity. You have on the bottom left of the slide the expected increase in power demand from data centers, fivefold in the next few years. That is actually a very significant trend and will contribute probably for about a third, if not more, of the rise in electricity consumption expected in the next 20 years. and look at what happens to the companies which are exposed to those phenomena. We've listed at the bottom right 2 US utilities, traditional utilities, Constellation and Vistra, whose share price has actually pretty much doubled in the past couple of years on the basis of a decarbonized power generation mix and also a positioning, notably thanks to their nuclear fleet, a positioning which seems pretty optimal to provide stable 24/7 electricity to data centers. So it's an interesting area because it's a space where renewables can't provide the electricity that data centers require because renewables are intermittent, as we know. So those data centers need baseload 24/7 electricity, and they probably want to focus on decarbonized sources of electricity. So nuclear provides the perfect source of energy for those data centers. So that's the type of re-rating that we are targeting, typically on the effects of the energy transition. The third phenomenon is enhanced returns, and that's quite counterintuitive. We've seen over the past 3 years a massive derating of renewables and clean power generation sources on general equity markets. The sentiment of the market was that renewables business models would be unable to pass through the effect of costs inflation. Well, actually, those statistics that you see on those charts, the US on the left-hand side, Europe on the right-hand side, show that this is a wrong, actually, conception and impression of the general equity investors. PPA prices, power purchase agreements, are an indication of the prices at which the operators sell their electricity coming from wind and solar. And as you can see, this price has significantly increased in the past 3 years. In the US, it continues to increase. In Europe, we've reached sort of a plateau. But the level of power prices that we're talking about are twice or sometimes 3 times the average prices of electricity of the past 20 years. So we've seen a much better ability of the space to pass through the effects of inflation into the final price of electricity. This has been a source of return enhancement. And again, this is a phenomenon which is largely overlooked by generalist investors. So what does it mean for the growth trends in the space? At a time when utilities and renewables in particular have largely derated on the market, as we've seen, actually earnings outlook has only been improving. On the left-hand side of the slide, you have the evolution of the consensus of earnings outlook for US and European utilities. As you can see, in the US, companies' earnings outlook have increased by about 8% in the past 12 months, 4 or 5% in Europe. Again, at a time when utilities have only derated. They are only starting to perform since January this year. And in terms of EPS growth profile, we expect a significant acceleration on the back of the phenomena that I have described, notably on the back of increased demand for electricity. So that bodes pretty well for our space. We've put at the bottom of the slide earnings expectations for the next 2 years for the subsegments where we invest. Utilities, 5% EPS growth per annum in average. That remains fairly low. Environmental services, 8%, and transportation infra, 12% per annum, which again leads to the long-term objective that we describe upfront in this presentation of 5 to 7% dividend increase per annum in our space. So de-risk model, enhanced growth, enhanced returns. Those are pretty strong fundamentals. Now, if you look at the valuations, we believe the market really overlooks the strength of the business model and the prospects that we are seeing for the future. In the upper part of the slide, we've shown the relative PE for European and US names. These are for utilities at the bottom, infrastructure overall. As you can see, we have a spike in the relative PE. About a month ago, those relative PEs were on historic lows. We've only seen a start of a re-rating over the past few weeks on the back of obviously general equity markets collapsing and utilities and infrastructure playing their role of defensive kind of safe haven. But as you can see, valuations are still on the lows relative, particularly for global infrastructure relative PE at the bottom left of the slide compared to the history of the space. What I would add is that our portfolio, EGL's portfolio, is actually even cheaper than the investment universe where it focuses on. EV/EBITDA about 10 times in average for our space. Forward-looking PE 13 times when typically infrastructure trade on more sort of 17 times, utilities 15 to 16 times. Our portfolio is only worth 13 times in average PE, and we deliver a portfolio dividend yield, which is also higher than the general equity market, but also higher than typical utilities infrastructure. Why is that? Very much because of our focus on those companies which are de-risking their model business mix, which are focusing on the fastest growth area of the space. So clear undervaluation of the space, as we can see, undervaluation of our portfolio. Those who seem to have assessed that undervaluation are mostly private equity investors. It's quite interesting to hear generalist listed equity investors really focusing on the kind of bond proxy nature of utilities and infrastructure, and only investing in the space when interest rates trend down. The space is still very much perceived by listed investors as a bond proxy. We believe that this is an all-dated perception, as we saw again in our performance track record, as we showed you. We believe this is a strategy in a space which is able to deliver annual returns which can be very close to double-digit, whatever the economic context. And those who tend to have that long-term perspective are mostly private equity investors. And they have raised massive amounts of cash over the past 12, 18 months, as I'm sure some of you know very well. If you take the 5 largest private equity specialists of infrastructure, I'm talking about Brookfield, Macquarie, Blackstone, KKR, BlackRock. They've raised more than $100 billion of new, fresh cash over the past 12 months to invest in infrastructure. That, we believe, will lead to an increase in M&A activity, which has only started. We've listed a few transactions in this table. The largest one was only a few weeks ago in Canada with the acquisition of Energex by Caisse de dépôt du Québec, who have paid a 58% premium to the last quoted price to take out Energex, and actually an 80% premium to the past month's average share price of Energex. So private equity investors are paying premiums which are actually far superior to what they've been used to paying, and that probably shows how conscious they are of the undervaluation of the space as it stands. We've actually indicated as an illustration of that the striking valuation gap that we see in the space of airports, listed airports. You have that at the bottom right of this slide 11. Listed airports in average trade on about 9.5 times EV/EBITDA, and the average of multiple paid in the last 10 transactions is close to 20 times, above 19. So that's the type of striking valuation gap which we see in the space, which we believe bodes well for the future evolution of valuations in listed infrastructure. I'll finish with an illustration of our portfolio, top 10 holdings. Hopefully names which for a lot of them are going to be familiar with you. Large caps, very diversified in terms of geographies, diversified in terms of types of business models, from regulated to more structural growth-oriented names, with our top 10 accounting for just above 40% of the portfolio. And as you can see, there's a mix in here of notably grid names like E.ON, National Grid, which most of you are familiar with. More growth-oriented name, you see Vistra, or environmental services like Veolia, and transport like Vinci. So we very much aim at maintaining that diversification to provide exposure to all the underlying thematics that I have described. Geographical exposure, I've already described it. I think we can skip that slide. Current focus, I mentioned 40 names, good concentration, and very much exposure to large caps. I think we can finish with a wrap-up, a space which has intrinsic characteristics of long-term nature, predictability of cash flows, and today with a specific opportunity, which we believe is largely related to the energy transition, with discounts to valuations, which I believe are clearly an anomaly. Neil, back to you. I hope I've stuck to the kind of 25 minutes you gave me.
Almost to the minute. Almost to the minute. Well done. Thank you very much for the presentation. That's very, very useful. So as I said at the start, ladies and gentlemen, at the bottom of the screen, there is a Q&A box, which please do feel free to type any queries or statements that you would like to make for us to discuss in the final period of the webinar. I mean, maybe just to get things going, I can certainly think of one at the moment, which is that, like I just noticed out there, the dollar is falling against, you know, a basket of other currencies, indicating that perhaps investors are changing their geographic exposure at the moment in terms of their allocation on their portfolios. How do you think about that in the context of your brief, as it were, within this investment trust?
Sure. Thank you, Neil. Geographic exposure. The first thing I would mention is that we aim, as I mentioned upfront, to maintain a good balance between North America and Pan-Europe. This is very much for risk purposes. Now, obviously, we try to be relatively opportunistic. And in 2024, we had enhanced our exposure to the US. This has helped us a lot. Some of the best performing names in the space like Vistra and Constellation were among our largest holdings, top 5 for the bulk of 2024. You know, Vistra was among the best performing names in the S&P even. That has helped us. Over the past 6 months, we've been taking money out of the US and transferring it to Europe. Why is that? Well, obviously, because of the election of Donald Trump, which has been a major disruption to the space, questioning the future of a lot of utilities business models over there. And also because valuations had reached a bottom in Europe, despite very strong fundamental outlook, as I described earlier. So today, our exposure to North America, as you see in this slide, is 36%. But in September 2024, so about, let's say, a bit more than 6 months ago, it was 44. So that's to show you that we allow ourselves to be reasonably opportunistic and changing the relative allocations of our portfolio. This is mostly driven by the bottom-up approach. And again, it's very much because we were finding significant investment opportunities in Europe, it's still the case. A lot of names in Europe were trading on 10 times PE, if not lower than that, while their equivalent peers in the US were trading close to 20 times. And at some point, when the growth profile, EPS growth profile, looks as strong as the one we described earlier, this looked like a striking opportunity to reallocate part of our assets to Europe. this is what we've done. So as you can see, Europe plus the UK today account for more than 50% of our exposure. So yes, we have decreased our exposure to the dollar zone and to the US market in general over the past 6 months.
Great, thank you for your thoughts there. We've had a question come in about the dividend and related to the comment you made about listed investors thinking about the fund being a bond proxy. So the question is, how stable is the dividend, and are we right or wrong to be looking at this as a bond proxy, thinking about interest rates and sort of frankly the either direction that they could move in over the coming weeks and months?
So the dividend, I would say, is a function of both our portfolio and our board's decisions on the quarterly dividend, which is being paid out to our investors for EGL. In terms of dividends coming from the portfolio, I would say I'm more confident than ever. As you can see, so the dividend for the portfolio is actually a bit above 4%. We have always said that a typical dividend yield from the portfolio would be around 4%, and this is very much what we have managed to see from my positions over the years. Why am I confident about this portfolio yield, average dividend yield from the portfolio? First of all, because the credit ratings and the balance sheet positions of our companies is actually very strong. The credit rating of utilities has improved significantly over the past 10 years, notably through asset disposals. Typically, the credit rating of companies in our space is around, I would say, BBB+, but we now have quite a few of our companies which are single A rated, some better than that. So I would say very strong credit rating, where people perceive that the gearing, the leverage of the space is very high, is actually purely on regulated utilities. But in that case, the debt attached to those projects is very much protected by the regulatory model and framework, protecting the returns that those investments are bound to deliver. So portfolio yield, I'm confident because of the balance sheet situation and because of the growth outlook. And as I mentioned, the 5 to 7% dividend growth per annum is very much valid. It's actually been stronger than that over the past 2 to 3 years. And that's actually only bound to stay strong in the next few years, as I showed. So confident on the portfolio side. Then I think we should add that we have a board of directors, obviously independent with EGL. The board is very much eager to showing that the dividends of the trust can increase very much in line with the portfolio. And as you will have seen over the years, the quarterly dividends of EGL have increased pretty much year after year by inflation plus something. And that's again in the hands of the board. The board is eager to showing that the dividends paid out to EGL's shareholders is able to increase year after year.
Great, thank you. So next question is in regard to the energy transition, and under Trump, it seems to be under attack. And question is, how is this shift in outlook being reflected in the portfolio?
Yes, thank you. This is obviously a very hot topic, if I may express it this way. Donald Trump is usually not good news for the space, I would say, but we've seen a first term of the Trump administration. And it's quite interesting to go back to what happened in 2016 and 2017, in his first election, which was obviously a major surprise to most of us and the world at the time. Donald Trump was first elected, and that's not so dissimilar from his current program, on the basis of ambition to boost the economy, and actually a lot of skepticism towards climate change, and eagerness, therefore, to cut subsidies and support to renewable energy. And in 2016, just after the first election of Donald Trump, the whole space collapsed worldwide by 15 to 20% in just a few weeks. Massive derating of the space for those two reasons. You know, if it's about economic growth, why bother investing in defensive asset classes? And frankly, the Trump administration is going to hit all the clean energy space. Interestingly, 2017 was one of our best years in terms of performance. Why is that? First of all, because when the space drops significantly like this, as specialists, it gives us an opportunity to acquire high-quality names on the cheap. And this is very much what we did. And at the time, we used the flexibility of EGL to add to its own leverage. And that's something which I have not mentioned yet. But in big market moves, EGL is able to use leverage up to 25% of its assets in order to play and add to positions when there are big market moves, which we've seen in 2016 and we've seen over the past few months since Trump's second election. And also there was another reason why it ended up being quite lenient for the space, is that actually the federal administration in the US cannot control everything. And most of the support to decarbonize energy sources are actually decided at the individual state level in the US. So when looking at the present situation, obviously, there's a lot of headwind. I explained that we have reallocated part of our exposure from the US to Europe in order to account for that. There's actually a significant risk to the IRA program, which would be a hit. Our belief today is that the IRA may not be rebuilt as a whole, because it's actually been the source of job creation in a lot of red states in the US. Republican representatives have already expressed their eagerness to maintain some kind of IRA, but clearly some parts of it are going to be hit. One example is offshore wind. Donald Trump is clearly an opponent to offshore wind. He's made it very clear over the years. So we've been very focused at avoiding exposure to US offshore wind as much as we could. For example, we haven't owned a name like Ørsted, one of the names which has derated the most over the years and the months, particularly again recently. We've avoided that one because it's overly focused on one technology, which we believe is at risk. The structure of our portfolio and the companies we focus on with EGL, it's very diversified. So that's our best answer to those types of risks. We can't avoid political risk. We can't avoid regulatory risk in our space. We're very used to it. But diversification of geographies and business models is our best answer, actually. And as you can see, again, our performance so far this year shows that we are able to very much perform and deliver superior returns, whatever the political and economic context.
Great, thank you. And just to build on the theme about risk, actually, and you talked about the predictability of returns from long-term cash flows. We have a question on, from an operational perspective, what are the biggest risks to revenues and profits in the portfolio, and to what extent? Is the infrastructure space fully supported, or are there any issues which might or have, as an example, cropped up?
So biggest risk to the portfolio is regulatory risk. And it's always been. So, obviously we aim at focusing on legislation, regulatory framework, which we believe are stable, are solid. It's very local. when you invest in Portugal, you have a very different regulatory framework than the one you would have in Spain. When you invest in Texas, it's very different from Connecticut. So you need to have that local understanding, which is very much what we spend our days on. But you can't avoid regulatory risk when you invest in the space. We had some exposure to Illinois, for example, which we were considering a pretty stable state. And then Illinois, pretty much last year, decided, to everyone's surprise, Illinois' regulator to cut our returns. So we took a big hit on our exposure to Illinois overnight. But you know what? Our exposure to Illinois was about 2 or 3% of the portfolio. So yes, you take a hit on the Illinois cut of our return, a regulatory decision, but at the portfolio level, it's hardly tangible. And that's very much the way we balance the risk. So biggest risk, I would say, is regulatory and political, but it will always be diluted by the diversification of geographies and types of business model. The risk of interest rates, which is typically the main risk perceived by generalist investors, is more a short-term risk, because in fact, the bond proxy nature of the space has dramatically reduced over the past decade. Our exposure to pure regulated models is currently about, I would say about 25-30%. It shows 30% on this slide for the pure regulated. It's actually a bit higher than it was 6 months ago. But it's, as you can see, only one part of the exposure. So this is the bond proxy nature of our portfolio. The rest is hardly exposed to rates, except for short-term phenomena, because infrastructure and utilities fall in that basket and fluctuates with the short-term fluctuations of interest rates. But again, for us, it's more a source of opportunities to find investments on cheap valuations when this happens on high-quality names. That's how I would describe the main risks to our strategy, which can be largely mitigated by diversification.
Great, thank you. You did in the presentation articulate a little bit about the size of your investable universe, but can you make any additional comments about that and also what the level of turnover is in the portfolio?
So yes, we've listed just under 400 names worldwide in the space, which gives plenty of opportunity to diversify exposure. As I mentioned, the portfolio typically holds between 40 and 45 names. An average position is around 2.5%. We have a soft limit at 8%. So if a stock that performs very well ends up reaching 8%, we trim it. That's a discipline which we have set for ourselves. So the sizes of the positions are between 1.5% and 5%, typically, depending very much on our degree of conviction on each of the positions. Turnover is between 20 and 30%, between 20 and 25%. It's actually rather low. We've decreased the turnover. We increase the turnover very much when there's periods of high volatility on the markets, which increased slightly, obviously, over the past couple of months. But over the years, it's around, I would say, 25% total turnover for the portfolio.
Great, thank you. Just moving on to ask about whether there is any space in the infrastructure sector for new entries, or are there large moats which benefit established incumbents, in your opinion?
So new entries, IPOs not much. It could come back, but the sector was very much out of favor over the past 3 years that we've discussed. Again, it doesn't show too much in our performance, but the renewable space, which is usually the source of new emerging companies and IPOs have been very much beaten up. So very few IPOs. New names actually come mostly from spin-offs. The reshuffling of the space on the back of the energy transition has led to some spin-offs over the years. I mentioned Constellation as one of the best performing names in our portfolio in 2024. Constellation was a spin-off from Exelon, a spin-off from 2 years ago. It's interesting because when Exelon, which was a network operator and a nuclear operator, when Exelon decided to spin off Constellation, the idea was actually to separate nuclear, because nuclear was actually sort of a mature type of business with no real growth future up until a couple of years ago in the US. And it proved to be the best performing names of the two, mostly because, as I briefly mentioned earlier, nuclear is making a significant comeback as a decarbonized source of 24/7 electricity, very much able to provide security of supply that data centers require. So I would say the universe doesn't change that much. A few takeouts, very few IPOs, but some spin-offs, and I believe we should have more probably in the next few years.
Great, thank you. Got a question on, I guess, taking into account the environment with respect to EGL, the environment that we're in, sorry, generally. And in your opinion, what will encourage generalist investors back into the space, noting there's a lot of risk-off pressure? So what's the most attractive aspect of EGL as an alternative to gilts, bonds, and other higher yielding equities? Any views on that?
I'm afraid interest rates are usually the trigger. I'm saying I'm afraid because actually the story I'm describing this morning about the strong fundamentals, improving outlook, pretty strong growth ahead of us, with beaten up valuations, is a story which we've been developing over the past few months, highlighting it. And still, EGL is trading at a discount. It's trading at a discount, which obviously comes on top of the discount that we see on the fundamental valuations of the names in our portfolio. And our read of that, I can't control the discount, although the board has launched a buyback program, very much to kind of support the returns. But what I would say is that usually what triggers a regain attention from generalist investors on the space is very much big moves on interest rates. And we've seen the recent decline in the US, UK, continental Europe in the past few months as very much a source of renewed inflows into the space, hence the outperformance that we are starting to see this year so far, 2025, which we believe is only the beginning of a trend. So this tends to be the main catalyst, not so much for the returns in our space, but much more so for the sentiment from generalist investors. So, again, today, this opportunity still stands. Low valuations, strong fundamentals, and a discount to NAV for EGL specifically.
Yeah, understood. And to build actually on that, we've got a question on your underlying holdings. I'm not sure if the chap or lady who's asked the question thinks that you have holdings in other investment trusts, but the question is, there's growing pressure for the UK renewables and core infrastructure investment trust investment trusts to consolidate and to reduce discounts to NAV. What current exposure do you have to the space, and how active have you been in encouraging boards to crystallize discounts to NAV?
Okay, so that's partly a question for my board, more than for me, I would say. You know, I'm not in charge of the structuring in itself, but more the portfolio. What I would say is that in terms of exposure, we have limited exposure to collective investment vehicles in this space. We have a very small position in Green Code, which some of you would be familiar with. But in general, as you see in this top 10 list, we're talking about individual listed names rather than collective investment vehicles. So that's the answer that I could give.
Yeah, that's
the
fine.
rest is more for my board.
Yeah. And actually, just to finish on the I'm just conscious of time. Actually, just to finish with the last question, actually, which again may be one more for the board, but just to ask your views. How is it that you use the investment trust structure here in regard to the EGL portfolio? Any comments that you can give on that at all?
So in two ways. Well, first of all, we're talking about long-term investments. So the stability that a closed-end fund provides very much corresponds to the type of business model we see in infrastructure. You know, we avoid the daily fluctuations of an open-ended vehicle. The second factor is really the facility of gearing that I referred to. The 25% gearing facility of EGL is something which we've used over the years. Over the past 8 years, gearing has delivered an annual incremental return of 170 bips. So 1.7% of incremental return for EGL's shareholders coming from its ability to increase gearing, to use gearing with an opportunistic approach, very much based on the conviction of the portfolio manager. And this is, I've mentioned it earlier, for us, a really strong tool in periods of volatility on the market, where we can top up, add on to our strongest convictions and positions in periods when you have a short-term discounting of valuations. So those are the two main assets for us of the use of a closed-end vehicle for an infrastructure strategy.
Understood. Very clear. And Jean-Hugues and Matthew, thank you for your time today. A really interesting presentation on the utilities and infrastructure sector and a way to access that. Ladies and gentlemen, thank you for your time and interest also. We think this fund is incredibly well placed to provide investors access to the infrastructure and utilities super cycle and generate very, very compelling performance in the months and years to come. You know, we've heard it from the horse's mouth, why this fund and why now. It's got access to long-term predictable cash flows from its investments, likely to be well sought after for its defensive qualities in this tougher global economic backdrop. And long-term performance has generated around 10% since admission in 2001. So very strong. Why Red Wheel? We've heard from the team led by Jean-Hugues, who has a rich pedigree in the sector, managing the fund since launch with a team of 7 managers and analysts to help the fund pick the right investments for your portfolio. So to wrap this all up, the fund will provide an offering that gives a compelling combination of diversification from long duration assets, critical to the functioning of society, providing stable and dependable revenue streams, inflation protection, preservation of capital, as well as income and growth. All of this at a time when the universe of funds in the sector, frankly, is being reduced. For example, BBGI this week, highlighting demand from private equity investors as articulated is out there. Now, in the coming days, the link to this recording will be made available, but in the meantime, Stifel are the house brokers for the trust and the ticker is EGL. So please contact them for information on acquiring shares. Thank you, everyone. Until next time.
Thank you. Thank you, everyone. Thank you, Neil.